Hi guys, Paul here with the Money Trend, and in this free video series we're going to discuss a few of the building blocks that you can use to construct a successful but simple trading system. I'm a great believer in keeping things simple. After 20 years of studying the market, I've come to the conclusion that a robust system is far better than a precise system. Precise systems tend to break down, whereas robust systems carry on working through all sorts of different market conditions and phases. So that's the way I prefer to construct. So today we're going to be talking about moving averages. Now, a lot of people poo-hoo moving averages, but they are useful, and they're useful particularly for identifying trend and getting a sense of what direction the market's in, and also assessing what sort of levels of momentum we're seeing in any given direction. You can open up a chart, put a moving average on it, or a couple of moving averages, and pretty much instantly see whether that particular market's worth trading or not. So let's have a look at typically what we may sort of do if we were putting a moving average on a chart, and then I'll introduce you to something that I've developed that's perhaps a little bit easier to use and also a little bit more accurate. So if we just put say for example a 7-period simple moving average on the chart, and typically we'll construct those from closing prices, and then we'll maybe put a 14-period moving average on the charts. We'll change that to 14, and we'll also change the color just so that we can see it more easily. So we can see here we've got some ideas here. A lot of people trade these crossovers. I wouldn't advise this, certainly not in isolation. Because the moving average is a lagging indicator, so you're going to be getting into the market always a little bit late. A lot of the move is over by the time you enter your trade. Also, you'd be whipsawed. Look at these here. These are where the market's essentially going fairly flat here. You're going to get whipsawed out of positions here and lose. There wouldn't be big losses, but you'd be losing some money here, and that's not. I'd rather try and stay out of these trades and sit out of the market rather than get whipsawed out of trades, even if for only small losses. So these are the sort of typical scenarios that people use. They put a couple of averages on top of one another. What you're typically trying to do then is find the best combination of moving averages, and that can be time consuming. Whether you're trying to do that by just putting them on the chart and having a look at them, or whether you know how to program and you can backtest, it still takes a lot of time to find the best combination. And of course the best combination in the past is not necessarily going to be the best combination going forward, so it's often not really a useful or practical thing to do. So I came to the conclusion a couple of years ago that I would do away with this almost completely. I do use them in some instances, but we'll perhaps talk about that later. Now what I'd sort of thought about was that a lot of people discussed how amateurs open markets. So by that I mean that in the morning a lot of your typical traders, which are doctors, engineers, professional people who are not necessarily financially educated, but very well educated people who are earning good money and can afford to invest and trade, they probably make up the bulk of the retail market, and they will place their trades either overnight, so the night before, or in the morning before they go to work. So this is what we mean by amateurs open the market, and professionals close the market. So the last trade of the day typically are done by the pros. They govern the closing prices, and this is a known sort of a phenomena. So it's why I guess that most of the time we pay more attention to the closing price than we do the opening, because it's a better consensus of the value of the stock is where it closes at rather than where it opens, and that's because more professionals are involved in that closing price than the opening price. So that brought me to the idea that maybe we could use a moving average of opening prices versus closing prices. So let's have a look at what that looks like. So if we pull a moving average over, and I'm again going to do a 7-period moving average of opening prices, and we'll make that red. not for any particular reason. You can make it any color you want. So here's our moving average of opening prices on a 7 period. This is a 1 hour chart on the, let's see, what have we got? Let's move that out of the way. We've got the Aussie dollar US dollar cross. So we're putting a 7 period moving average on there, and that's what it looks like. And then that's a moving average of the opening prices. Now most people don't use the moving average of opening prices, or not typically anyway. So now I'm going to do my next one. I'll do that in green, and I'm going to do a simple moving average of closing prices. I found that simple moving average works perfectly well. There's no need to complicate this. As I say, we're not looking for the ultimate inaccuracy, because it doesn't exist. It's a bit of a myth to go down that road. You're going to spend a lot of time trying to find the most accurate indicators, when really what you should be seeking is robustness. So here we've got the green is the moving average, 7 period moving average of the closing price, and the red the 7 period moving average of opening prices. And as we can see here, where it crosses, we're getting in pretty early into these moves, and they tend to be fairly reliable. If we can see, we had a big high volatility drop down here, but it didn't affect the average. It didn't fall. So we could have traded it even in isolation, though I don't recommend you do it. We could have traded this here. We could have traded this profitably. We could have traded this profitably, and this one. These here, we wouldn't have made any money on these, but we wouldn't have lost any either. So if you decided to trade these, you wouldn't have come out a loser. You'd have probably come out flat. Another profit could have been made here. A little bit of whipsawing here, so you may have possibly got into a trade there and lost. A good profitable trade here, another here, probably a flat one here, and another profitable one here, and another one setting up just now. So this gives you a window into how I start constructing my charts and look at. I will always first look at the moving average, these moving averages, not necessarily for this periodicity. That will depend on the market and the time frame that I'm looking at. But I'll always look at the charts first by overlaying these two moving averages, the moving average of opening prices and the moving average of closing prices. When the moving average of closing prices is above, it's kind of telling me that the professionals are in control of that market, and that they're moving the market higher. When it goes below, they're moving the market lower. Now, these two averages never stray far from one another, for obvious reasons, because they're the same period. That's the other good thing about this system. You don't have to back test hundreds and hundreds of combinations, because you're always using the same periodicity. You use the same period for both averages. So if you're looking at it, if you want to overlay a 5 period moving average, both moving averages are going to be a 5 period. You're not having to use a 3 period and a 7, or should I use a 5 period and a 9, or a 9 and a 12, or a 9 and a 14. This is dead simple. So you can just click on each one of these and change the periodicity for any given chart, and then it'll give you a rough idea of what's giving you the best signals for that chart for that time. And then just look at it. You can get a quick visual, and it'll tell you. I can see at a glance this is a highly tradable chart. We could have made some good money on this chart. However, there are other ways that we can improve. Even still, we can improve on these indications of where the market's going, and I'll touch on that in the next video. And I'll show you another indicator that we can introduce, which is going to probably keep us out of a lot of these marginal or losing trades. So I hope you've found this useful, and we'll see you on the next one.